Hello and welcome to Gold and Silver Assets. It's Sunday, the 2nd of August 2020. In the comments section, we've been hearing how much people have made from their stacks, and this is really nice to hear about. We did have one viewer who asked how much gold they should own, so today we're going to talk about gold ownership. First of all, I'm not a financial advisor, so I can't give you individual advice. And also, you are all individuals. And so what's right for one of you won't necessarily be right for another. How much gold is right for you will depend on a few things. So firstly, what's your individual situation in terms of things like income, debt level, commitments, and your future goals? And these will determine how much you have available to invest. You then need to consider what proportion of your investable amount you want to assign to gold. Now, I think that should really partly depend on what your beliefs are about gold and the financial system in general. If you believe that the fiat system will remain strong and that the economy and financial system will steam ahead like it has done in past decades, then having minimal or no gold would match your beliefs. Then there's the spectrum, which goes from one end where you might think that inflation's coming, but then that will be subsequently put under control like it was in 1980. And then you've got the other end of the spectrum where there's the belief of total collapse of fiat currencies and the financial system. So I think that the proportion of gold you hold should partly be based on where you are on that spectrum. The other thing to consider is what your risk tolerance is. There are risks associated with holding any asset, and yes, that does include cash and gold. And I'll go into that in a bit more detail, perhaps in another video. But basically, it's up to you to assess what those risks are for you and use that to help make your decision. One other thing that can be useful is to know what other people, particularly smart people, are doing. But the problem is that finding data regarding private gold ownership is very difficult to come by. The reason for this is that one of the desirable properties of gold is privacy. I like one of the jokes that they have over on the Belang P YouTube channel, which has the quote, "I lost my gold in an unfortunate boating accident." I thought that's a good one there. Let's start by looking at how much above ground gold there actually is. Well, there's over 197,000 tonnes of it. And if we were to lump all of that together to form a cube, then it would be 21.7 metres high. Of that, a whopping 47% is actually in jewellery form, and 21% is in private investments, and 17% is in central banks. So what if we were to divide all the gold equally amongst the whole population? Well, that would give us 0.81 ounces of gold per person. If we just divided the private investment gold, then that would only give 0.18 ounces per person. And if we added jewellery to that private investment, then that would bring it up to just over half an ounce per person. So by this metric, if you own more than 1 ounce of gold, you're actually doing quite well. However, this isn't a very realistic metric because just like fiat currencies, gold will never be evenly distributed. What have central banks been doing in terms of gold? Well, on this chart, it shows that from 1845 up until around 1970, they were steadily accumulating gold. And that dropped off quite sharply in the late 60s, really. And that continued well into the full fiat era. And on this chart, we can see that for a long time, central banks have been net sellers of gold. But that seemed to change in around 2010 when they became net buyers. But remember that this has mainly been driven by central banks in the East and Middle East. As far as we know, most Western central banks are not buying gold. Perhaps they're not buying gold because they think that they already have enough. So this table shows the official gold holdings in tonnes and as a percentage of reserve assets, and this is shown for different countries. Now, I know that there is a lot of controversy about the accuracy of these tonnages, but this is all we've got to work with, so let's just go with it. In terms of reserve assets can include gold, but also include things like currencies and special drawing rights. Now, according to this table, USA holds 75% of its reserve assets in gold, whereas for China, it's only 2.4%. This all seems a bit odd to me, but then I realise it's kind of a bit like saying that someone says that they have $100,000 worth of gold, but then they don't mention that they have 5.2 million in bad debts on their books. So what about gold allocation in terms of investment portfolios? So this chart shows how portfolio composition has changed over time. So debt in its multiple forms has ballooned both in terms of absolute amount as well as proportion of portfolios, and they make up a big chunk. Equities have also increased in proportion over time. But on this chart, gold is barely visible. So those are those yellow tips at the top of each bar. Let's look at that a little bit more closely. On this chart, we can see that in the last 30 years, gold has only been less than 1% of all financial assets for most of that time. And in fact, it was actually less than 0.5% for most of that. Interestingly, in 1960, it was as high as 5%. Now, remember that financial assets account for trillions of dollars. And so even just doubling from 0.5% to 1% in gold would exert significant upwards pressure in the price of gold. The fact that gold is part of the global financial assets portfolios, that tells me that as an absolute minimum, having 1% of your investments in gold would be prudent. The silver market is even more minuscule. So from this chart, you can see that in 2004, it made up only 0.04% of gold assets. That's really, really tiny. And remember that the allocations for gold and silver that I've discussed here are based on full belief in debt and equities and the fiat system. Let's look at the other end of the spectrum and look at people who believe that the fiat system is going to collapse. So the examples I'm going to give are all people who own businesses that sell and store precious metals. Now, these people do tend to get a lot of stick for talking their own book. And I've heard some people say, oh, well, if they believe so much in gold, then why are they selling it to other people? And I don't think that that's valid at all. Firstly, we all need to make a living in some way. And you need to make a living in order to be able to buy gold in the first place. Their businesses are just their own way of making a living so that they can add to their own personal stacks, but also they're doing something that they strongly believe in and actually are helping other people in achieving the same goals. Secondly, these guys do have skin in the game, so they do invest a large proportion of their income into the precious metals. I don't know the exact figures for everyone, but certainly for Egon, it's over 50%. And for Andy, well, he says that he's been in the habit of buying precious metals every couple of weeks, regardless of the price, and he's been doing that for decades. This is Daryl and his brother Brian from As Good as Gold Australia. And I really like these guys. They've got a really lovely old school Aussie charm about them. Anyway, they sell gold in Australia and they often give us really good vignettes about themselves and their clients. And they've been buying gold for themselves for years. And basically, they've openly said that they're all in. I also think that Mike Maloney and Gregor Gregerson are also pretty much all in. But interestingly, they've taken things a step further and are basically playing the gold to silver ratio. So therefore, both have actually mainly invested their funds to accumulate silver with the aim of changing to gold when the gold to silver ratio drops. That way, they aim to end up with even more gold at a later stage. I think that is a very valid strategy, but I think you've got to have guts to do that. My worry would be not being able to get gold when I actually want it, if there are any shortages, and then I'll be stuck with silver. Obviously, these guys probably won't have that problem because they've got direct contacts with wholesalers and so on. I've talked about the spectrum of gold ownership, and the percentages seem to range anywhere from 1% to 100%. Now, of course, there are lots of other factors to consider, and I'll talk about those other factors in future videos, but I do like to keep these videos relatively short and digestible. Overall, it's up to you to decide where on that spectrum is right for you. I'm sure many of you are itching to know my personal answer to this question, how much gold is enough for me? Well, my answer is more. Next up, the market update. Let's start by going back and looking at that comparison of the Dow from the Great Depression and the current day. So I hadn't forgotten about this. It was just that things weren't really doing very much. Price has been moving kind of sideways for a while. And as you know, I do like to look at the bigger time scales. And so following this every single week probably wasn't going to be that helpful to anyone really. Anyway, let's go back. So, as we remember, back in 1930, there was a 48% drop, and the peak to trough was 48% in 2 months. That was followed by a 48% rise, and that actually took quite a while. That happened over 5 months, and again, that's from the trough to the peak. What's happened in 2020? Well, we had a very steep drop. It was only 38%, so it's less than it was in the Great Depression. However, it did happen nearly twice as fast there, so it occurred over 40 days from peak to trough. And we've had this rise, and this was actually a 48.8% rise, and from that trough to the peak it was 2.6 months, which again is just over half the time of this rise. So it's interesting just looking at those proportions, which seem to be quite similar. And of course, things are never going to be identical. So what we had back here was we had this ascending wedge, price popped out the top and then just rolled over. And interestingly, just at the apex of that wedge is where things just plummeted from there, basically. And if we look at 2020, again, price popped out of the top. So I've tried to draw this wedge in the same way that it was drawn in 1930. So yeah, price popped out the top, came down, but actually the bottom of the wedge ended up being support. And so since then we've been moving sideways, but never really been able to breach the top of that wedge again so far. And momentum seems to be slowing. Certainly once we drop below the wedge, it's just been knocking on the lower trend line really, and now it's just kind of slipping downwards. So the question is this going to play out just like this? The answer is I actually don't know. There are a couple of possibilities here. A lot of people are saying, oh well, you know, there's unlimited intervention. Of course there was intervention in 1930, so in this time the banks and big financial players were actually putting money into the stock market to try and keep it propped up, and that obviously failed. But the argument here could be, well, you know, at that time it was limited because of the link to gold, whereas nowadays, you know, there are no limits. So that could be enough to just push things up a lot further. But then the flip side of that is that, well, maybe they need to have a further drop to have an excuse to print more. You know, maybe they can't just print willy-nilly right now without having such an excuse. I don't know. Basically, for me, this doesn't have any asymmetry in it. It could actually go either way. I'm erring on the side of a down move just because, you know, this is an imprint of human psychology here, and this pattern has been replicated in so many bubbles that we've seen in the past. So if you look at my video Bubble Tops and Pops, that goes through some of them. But anyway, at the end of the day, I don't really have a dog in this fight. As I said, there's just no asymmetry. Whichever direction it goes, I think it will still be good for the precious metals. And so I'd rather stay out of this game. And just going back again to learn some lessons, I guess, from some of the analysis that we've done. So the first thing that we were talking about, remember we were likening this to lemmings falling off a cliff. And so the first thing is that we don't know where the cliff edge is. And so when we were first looking at this, I was talking about the wedge actually being over here, like this. And so I was assuming the cliff edge was around here. And actually that wasn't the case. Now I'm thinking it's probably around this area here where we are now. There are lots of different ways that you could draw this lower line. So another possibility is to actually draw it like this. This line here was actually drawn from the line chart. So that's actually the, you know, the closing prices each day. So the first problem is we don't know where the edge of the cliff was. The second thing was that chart patterns can fail. So we thought we had this smaller wedge here, and you know, it did look pretty good and it did drop out of it, but it didn't proceed to continue downwards to the target. It actually just turned around and moved upwards. But the other interesting thing to note is that we saw lots of wedges within this. So there's one there, there's another one over here. And so what we're seeing is lots of wedges within a much larger wedge. So, you know, that's a kind of fractal thing going on there. So is it that this first wedge was actually the clue to the larger pattern? Sometimes I've seen that also with triangles that are forming as well. So the thing to learn here is that sometimes patterns can be called too early, and so it's a matter of being wary of that. But I don't know how to avoid that really. That's a tricky one. I think with this one though, that comparison with the 1930 Dow would have helped, because when I first called this wedge, I didn't actually look at the timescales, so how long it took to reach that, what we thought was the peak there. So, you know, that's something that might have helped as well. So I think it's useful to try and look back at the things that you've analysed and try and pick out, you know, what the issues have been, because, you know, nobody's ever going to get this perfectly right here. And so it's really good to kind of keep a diary of what your thoughts are and learn from that. Next, we'll look at gold in US dollars on the monthly scale, and whoa, look at this massive green candle here. That's huge. And it's moved to all-time highs in US dollars. Of course, it has been at all-time highs in other currencies for quite some time now. And as we said last week, this is a momentous move here. So we are looking for more upside in the longer term. But remember, now we're at 4 monthly candles. The most we've ever seen was 6. So yeah, potentially we could be moving further up. But of course, the more candles we have and the further up we go, potentially the bigger the fall. So, you know, also this move has been very, very rapid. It's kind of parabolic move really, and parabolic moves usually don't end very well. You usually get a sharp movement downwards as punishment. So let's see. I am expecting a red candle in the next 1 to 2 months, so we'll keep a watch on that. But as I said before, I'm not expecting price to go below the 1741 level. It may not even get that far, but that's probably the most that I'd be looking at in terms of downside. And let's have a look more closely at the 4-hourly scale and see what's happening. So we had this big rise here, and on this 4-hourly scale, we've got what looks like an ascending triangle. Now, I just wanted to point out this here, which basically just poked out of the top of that triangle and then got smashed back down again. And it's this kind of trading action that makes it very difficult to trade. So if we see a break above the top of this, then yeah, there's more upside here. But remember, we've got this big round number of 2000, and that's going to be a kind of psychological level that may affect things. It's very difficult to know. Price could steam upwards. Certainly if it does go through that 2000 level, then, you know, we've got quite a big target here of 2050 further upwards. Of course, this could break out lower, and so it's also worth watching this lower trend line, in which case then we'd be going back down again. Silver did exactly what we thought it would. So this is silver on the monthly scale in US dollars, and we were looking at these areas here as a resistance zone. I plumped for the middle of that zone and said 27 was the target, but actually price got rejected before that at just above the $26 level. So I think it went up to about $26.20, and that coincided with the bottom of these wicks here. So this whole zone here between 26 and 28 is going to present some resistance there, so it's not going to go through easily. What's going to happen here, there's going to be a bit of frustration going on. We've had this amazing excitement with this big move here, but because of this, I think we're going to have a little bit of choppiness and sideways movement or consolidation before we make that next step upwards there. And Here we have silver in US dollars on the daily scale, and not really much to indicate what's coming next. So we saw that rejection here at 26.20. It could have another stab at that before making its move down. We've got this trend line that goes back until March, and I think that may well hold actually. And so the lowest we're looking at is $20 here at the moment if we get a drop. Of course, as I said, price may well just consolidate here before making its next move upwards. And looking at the miners, they've been a bit lackluster considering that massive green candle we had in gold. We haven't seen the equivalent here in terms of the miners. And in here, we can actually see that they're in a short-term downtrend here. Over a longer time span, you can see that we are still in an uptrend and that has not broken. And so we still have to assume that price is going to keep moving upwards until we see a break of that. And remember that we do still have all these messy gaps that do bother me a bit, but let's see what happens. Well, I'm sure most of you are basking in warm sunshine. I'm freezing over here. I always whinge about the cold, so I'm off to have something hot to try and warm me up. That's it from me this week. All the best and see you next week. Bye.